In January of this year, Warren Buffett stepped down as CEO of Berkshire Hathaway after 60 years running the company. He was 95 years old, and in his final months in charge, he did something that looked completely backwards. While the stock market kept climbing to record highs, he kept selling. By the middle of 2026, Berkshire was sitting on $397 billion in cash, not invested, just sitting there. Most people assume he's doing this to dodge a tax hike before rates go up. That explanation is everywhere right now. But it's not true. The capital gains rate he'd supposedly be avoiding never actually changed. So if it's not taxes, what is it? There's a pattern in Buffett's career. He has only built a cash pile this size twice before in 60 years. Both times, a crash followed within a couple of years. That's what this video is about. If that pattern is happening again, it changes how you should be thinking about your money right now, not after the headlines catch up. My name is Alex, and if you've ever felt like the market makes less sense the more money you put into it, stick around. The reason has nothing to do with timing the market. I'm going to show you what Buffett is seeing in the data right now, and the two other times in his career when he made this same move right before a crash. Once you understand this pattern, you'll start reading market highs completely differently, the same way Buffett does. And the way this number got so large is not really about instinct. It's about math. Berkshire's $397 billion cash pile explained. Here's a number that should stop you for a second. If Warren Buffett wanted to, he could write a check today and buy roughly 476 companies, the size of an average S&P 500 stock, in cash, without selling a single share of anything else he owns. That's what $397 billion actually buys you. Let's talk about how that pile got so big, because the growth alone tells you something. 3 years ago, Berkshire's cash sat at about $129 billion. A year ago, it had climbed to roughly $348 billion. Now it's at $397 billion, and it's still growing. That's not a company hoarding money out of habit. That's a company selling faster than it's buying, quarter after quarter, for 3 straight years, and most of it isn't sitting in a checking account. About $52 billion is actual cash and short-term holdings. The other $345 billion is parked in short-term U.S. Treasury bills, government debt that matures in less than a year. So even the cash is playing it safe. Buffett isn't just avoiding stocks. He's avoiding anything that ties his money down for longer than a few months. Think about what that means in practice. Picture a 44-year-old ER physician outside Charlotte, North Carolina. Call her Renee Castellano. She just financed a Porsche 911 GT3 at $93,000 and put a signed offer on a lakefront lot in Cornelius on Lake Norman, listed at $2.3 million. She's not reckless. She's doing what feels like the responsible version of enjoying a good year. Her portfolio is up, her income is high, and everyone around her is buying too. Buffett is doing the opposite. He's the guy holding cash while the market throws a party, and honestly, that should make you a little uneasy. Not because Renee did anything wrong, but because the two of them are looking at the exact same market and reaching completely different conclusions about what happens next. Here's the part that's easy to miss. This isn't one bad quarter of selling. Between 2023 and 2024 alone, Berkshire sold a net $172.9 billion more in stock than it bought. During that same stretch, the market kept climbing. So Buffett wasn't reacting to a downturn. He was selling into strength, while everyone else was buying into it. To put the scale of that cash pile in perspective, it's larger than the entire yearly economic output of Portugal, larger than Finland's. This is money that could reshape entire industries, and instead, it's sitting in short-term government debt, earning a modest return while Buffett waits for something. That's the real mystery here. Not that he has cash. Rich investors always have some cash on hand. It's that he has this much, growing this fast, at a moment when doing nothing is supposed to be the losing move. So naturally, people want an explanation. And if you've turned on financial news anytime this year, you've probably already heard one. It's simple, it's tidy, and it sounds like it makes perfect sense. There's just one problem with it: why the capital gains tax excuse fails. Turn on any financial channel this year and ask why Buffett is selling, and you'll get the same answer within about 30 seconds. Taxes. He's supposedly rushing to lock in gains before a capital gains hike hits. It's a clean story. It's also wrong. Let's actually check the math instead of repeating what everyone else is saying. The federal long-term capital gains rate this year still tops out at 20%. Add the net investment income tax, which is an extra 3.8% for high earners, and you land at 23.8%. That's the real top rate. And here's the thing nobody mentions when they tell this story. That structure hasn't changed since 2013. There's no hike coming. There's no deadline to beat. The tax law Buffett would supposedly be racing against simply doesn't exist. So if the tax explanation doesn't hold up, why does it keep getting repeated? Because it's simple. And simple stories spread faster than accurate ones. But Buffett's own history should have killed this theory before it ever started. Go back to 1986. Corporate tax rates jumped from 28% to 34% that year. A real increase, not a rumored one. Buffett didn't restructure a thing. He kept holding. He bought his Coca-Cola stake a couple of years later, in 1988, and held it through the 1990s, through the 2008 crash, through every rate change since, including this year. That's not someone who sells because of a tax form. That's someone who's been telling you for decades that taxes are the last thing on his list of concerns. Now, compare that to how a lot of investors actually behave. Picture a 51-year-old orthopedic surgeon in Scottsdale, Arizona. Call him Derek Halverson. He read an article back in the spring claiming capital gains rates were about to jump. So he sold off a chunk of his Nvidia position early, paid the tax bill, and used part of the proceeds as a down payment on a Cessna Citation CJ3. 6 months later, the rate hike he was avoiding never happened. He paid real money to avoid a tax increase that was never real in the first place. That's the trap. Not that Derek is careless. It's that acting on a rumor feels like discipline in the moment, even when the rumor is false. And if a private investor can get talked into moving hundreds of thousands of dollars based on a headline, imagine how much noise Buffett has had to filter out over 60 years of running a company worth over $1 trillion. Now here's where it actually gets interesting. If taxes aren't the reason, and Buffett himself has never once let a tax change move him out of a position he believed in, then the tax story isn't just wrong. It's a distraction from the real answer. Because that wave of selling you just heard about in the last section wasn't triggered by a line on a tax form. Something else was pulling at him. Whatever this is, it's not new to him. He's felt this exact pull before, decades ago, more than once. And each time he made the same call. Walk away from the market while everyone else was still buying in. Buffett's 2 previous market exits. 60 years is a long time to run a company, and in all that time, Buffett has only pulled this exact move twice before. Twice in 6 decades, he looked at a hot market and simply walked away from it. So when it happens a third time, maybe that's worth paying attention to. The first time was 1969. Wall Street was deep into what people called the Nifty 50, a group of stocks everyone treated as guaranteed winners. Polaroid, Xerox, companies that seemed too big and too beloved to ever go down. Buffett looked at that market, looked at his own investment partnership, and couldn't find a single thing worth buying at those prices. So he did something almost nobody does at the top of a bull run. He shut the whole partnership down and handed the money back to his investors. Just a few years later, by 1973, Polaroid had lost 91% of its value. The guaranteed winner wasn't guaranteed at all. Fast forward to 1999, different decade. Same story, wearing a new outfit. This time it was the dot-com boom. Companies with no profits, sometimes no real product, were getting valued in the billions because the word internet was in their pitch deck. Buffett sounded the alarm that the speculation wouldn't hold. Not long after, the Nasdaq lost close to 3/4 of its value. Here's what connects both moments, and it's not luck. Buffett watches something called the Buffett Indicator. It's a simple idea. Take the total value of every publicly traded stock in the country and compare it to the size of the actual economy, the real goods and services being produced. When that number creeps up toward 200%, Buffett has said you're playing with fire. In 1999, right before the dot-com crash, it hit exactly that level. And this year, it's sitting at similarly stretched territory. Not a guess. Not a feeling. The same number, in the same danger zone, for the 3rd time in his career. Think about how that plays out for someone who isn't watching that number. Picture a 38-year-old dermatologist in Austin, Texas. Call her Whitney Faircloth. Her practice has had 2 great years in a row. And this spring, she leased a Range Rover Sport SV and put a deposit down on a $2.1 million home in the Rob Roy neighborhood near Lake Austin, financing most of both on the assumption that her portfolio, heavy in tech stocks, would keep compounding the way it has the last 3 years. She's not wrong to enjoy her success, but she's making a bet on the market staying exactly the way it looks right now, forever, which is the same bet Nifty 50 investors made in 1969 and dot-com investors made in 1999. And look, I'm not saying every hot market ends in a crash. Markets climb for real reasons sometimes, and staying in cash forever is its own kind of mistake. But Buffett isn't reacting to a headline or a bad news cycle. He's reacting to a number he's watched cross this exact threshold twice before, both times right before the floor gave out. So the real question isn't whether Buffett is being paranoid. It's what he's actually seeing when he looks at today's biggest stocks up close, because that's where this pattern started to show up first. Apple, Bank of America, and the AI trade. Here's a question worth sitting with for a second. If Apple is still one of the best-run companies in the world, why did the man who once called it his favorite holding cut his stake almost in half? For years, Apple wasn't just a position in Berkshire's portfolio. It was practically the portfolio. At its peak, it made up close to half of everything Berkshire owned in stocks. Buffett called it one of the best businesses he'd ever seen. And then, over the past couple of years, he sold most of it down. Apple now sits at roughly a fifth of the portfolio. That's not a trim. That's a company he loved, cut down to a third of what it used to be. So what changed? Not the business, really. Between 2022 and 2024, Apple's sales grew by a sluggish 1.5% a year. Meanwhile, the stock price kept climbing, pushing investors to pay more than 30 times the company's annual earnings just to own a piece of it. The business was walking. The stock price was sprinting. And when those two things stop matching up, Buffett has always sided with the business, not the price. Now, this isn't just an Apple story. It's the whole AI trade. The biggest tech companies in the country have poured well over $200 billion into AI infrastructure. But look closely at where that money's actually going. NVIDIA invests billions into OpenAI. OpenAI turns around and spends that money buying NVIDIA chips. Microsoft sends OpenAI billions more, mostly in the form of cloud credits for Microsoft's own servers. It's the same money, moving in a circle between three companies, and a lot of it never touches an outside-paying customer at all. Meanwhile, OpenAI is reportedly spending $1.25 for every dollar it brings in the door. Charlie Munger, Buffett's longtime partner, saw this coming before he passed. He compared the AI build-out to the dot-com era, when companies laid thousands of miles of fiber optic cable for internet demand that hadn't arrived yet. Most of that cable sat dark for years. Some of those companies went broke waiting. Picture a 46-year-old orthodontist outside Nashville, Tennessee. Call him Grant Ostrowski. He's put a large share of his retirement account into a handful of AI infrastructure stocks this year, the same names showing up in every headline, and he recently picked up a Rolex as a reward for a strong year. None of that is reckless on its own, but he's making the same bet the market's making right now, that this circular spending turns into real, lasting profit before the enthusiasm runs out. Now here's the part that should stop you from writing this off as Buffett just being scared of technology, because that's not what's happening. During this same stretch, Berkshire grew its stake in Alphabet by over 200% in a single quarter. So this isn't Buffett running from tech. It's Buffett being selective about which tech he trusts and walking away from the stories that sound better than they check out. And that's really the whole pattern here. Not fear of the future, a refusal to pay for a future that hasn't shown up yet. But stock prices and circular AI deals are only half the picture. The other half was showing up somewhere most investors weren't even looking. The Sahm rule and bank bond losses. There's a warning system that's called every single recession since 1950 correctly, with only one false alarm in 70 years. And it went off 2 years ago, right when Buffett's selling hit its heaviest pace. Most people never even noticed. It's called the Sahm rule, named after the economist who built it. The idea is simple. Take the unemployment rate, average it over 3 months, and compare that number to its lowest point over the past year. If it climbs half a percentage point above that low, a recession is either underway or about to be. In July of 2024, that's exactly what happened. The 3-month average had risen 0.53 points above its recent low. The alarm rang. And that timing lines up almost perfectly with when Buffett accelerated his selling of Apple and Bank of America stock. Now, here's the honest part, because I'm not going to pretend the story is simpler than it is. That alarm has since cooled off. By this summer, the reading had dropped all the way down to 0.07, far below the threshold. The labor market stabilized. No recession showed up on schedule. So does that mean the warning was wrong? Not exactly. Think about what a smoke detector is actually for. It doesn't wait until the house is fully on fire to go off. It goes off the moment something starts smoldering, so you have time to act before it spreads. Buffett didn't wait to see if the smoke turned into flames. He started moving his money the moment the alarm sounded, which is exactly why his biggest selling happened 2 years ago, not now, after the fact. While that alarm was ringing, something else was quietly breaking inside the banking system. Banks like Bank of America had loaded up on government bonds years ago, back when interest rates were near zero. Then rates shot up, and the value of those older, low-rate bonds collapsed. By 2023, Bank of America was sitting on a hole of unrealized losses, close to $100 billion. Buffett had been the bank's biggest supporter since 2011, when he put up a $5 billion lifeline during a rough stretch. Starting in the summer of 2024, he began aggressively selling that position down. His stake has been cut roughly in half since then. Picture a 53-year-old anesthesiologist in Greenwich, Connecticut. Call her Denise Okafor. 2 years ago, she was eyeing a Cartier Santos de Cartier skeleton watch and a stake in a friend's regional bank stock, drawn in by a dividend yield that looked too good to pass up. She didn't know that bank was sitting on a mountain of the same underwater bonds. She held on, the bank held on, and it worked out this time. But that's the exact setup that took down Silicon Valley Bank in a matter of days back in 2023. It's a theoretical loss right up until depositors get nervous and start pulling their money out for real. One more piece locks this together. For nearly 2 years, short-term bonds paid out more than long-term ones, a warning sign called an inverted yield curve. Between late 2024 and this year, that curve normalized as the Federal Reserve started cutting rates. Here's the thing about that. The Fed doesn't cut rates because everything looks fine. It cuts because it's seeing cracks the rest of us haven't spotted yet. So an early alarm on jobs, a hidden hole in the banking system, and a Fed quietly stepping in. 3 separate signals, all pointing the same direction, all lining up with the exact moment Buffett started building the largest cash position of his career, Greg Abel's cash reserve, and what's next. Here's something that seems backwards until you think about it for a second. Buffett has spent 60 years telling people that cash is a terrible long-term investment. So why is he holding more of it right now than at any other point in his career? Because right now, he's not treating it as an investment at all. He's treating it as ammunition. When everything in the market is expensive, cash looks lazy just sitting there, earning a modest return. But the moment prices fall and good businesses go on sale, that same lazy pile of cash becomes the most aggressive tool in the room. Buffett has always refused to pay tomorrow's prices today. He'd rather wait years for the right price than overpay for a great company. We've actually watched him run this exact play before. Go back to 2008. The entire financial system was scrambling for cash, and Buffett had it. He gave Goldman Sachs a $5 billion lifeline on terms so favorable, they're still taught in business school classrooms today. He did the same thing with General Electric. He wasn't predicting the crash with some special insight. He was simply the one person prepared enough to buy when everyone else was forced to sell. Back then, he had tens of billions ready to deploy. This time, he preloaded almost $400 billion, at the peak of a market that still hasn't cracked. And then came the handoff. On January 1st of this year, Buffett stepped down as CEO after 60 years, passing the role to Greg Abel. But notice the timing. The cash pile was already built before he handed over the keys. It's less like a retirement and more like Buffett loading a weapon and passing it to the next person in line with one instruction. Wait for the right moment. Here's what's interesting, and it's worth being upfront about, because Abel isn't just sitting on his hands either. This year, Berkshire resumed stock buybacks after a pause of nearly 2 years, repurchasing up to $11 billion of its own shares in a single quarter, the most it's ever bought back at once. Abel also personally purchased $15 million of Berkshire stock, roughly his entire after-tax salary, and said he plans to do it again every year. That's not the behavior of someone bracing for disaster. It's the behavior of someone confident in the foundation Buffett built, while still keeping the bulk of that fortress in cash for whatever comes next. Think about what that kind of patience actually costs someone in real life. Picture a 57-year-old radiologist in Naples, Florida. Call him Patrick Delacroix. He's spent the last 2 years watching his neighbor buy a Bentley Continental GT Speed and close on a $5.4 million waterfront home on Gordon Drive, while his own portfolio sat mostly in cash, waiting for a better entry point that never quite arrived. It's not comfortable watching other people enjoy the run while you sit it out. Buffett has felt that same discomfort 3 separate times in his career. Each time he sat through the uncomfortable part anyway. So here's where all of this actually leaves us. A 95-year-old man built the largest cash position of his career, then handed it to his successor with a single word attached to it. Wait, everyone else is still dancing while the market keeps climbing. Buffett already left the party early, twice before, and both times he was right to. What Buffett's cash actually bets on. Here's the realization worth sitting with. Buffett isn't predicting a crash. He's just refusing to pay today's prices for tomorrow's uncertainty. The same choice he's made exactly twice before in 60 years, and both times the market proved him right. A few things are worth holding on to here. Cash isn't a weak position. It's a decision to wait for a better one. Warning signs like the Sahm rule often do their job quietly, years before the headlines catch up. And a rising stock price is not the same thing as a healthy business, no matter how convincing it looks in the moment. So here's something to watch in your own decisions. Next time an investment feels obvious because everyone around you is making it, ask what Buffett would be checking instead. The price or the business underneath it? There's still one open question worth thinking about. Greg Abel now controls that $400 billion decision. What he does with it and when will say more about where this market is really headed than anything on the news this week. If this changed how you're looking at your own portfolio, that's worth sitting with.